Okay. And we're live. Hi, Ruby. How are you?
Hi, hello, Danielle. How are you?
Oh, nice to see you. Thank you so much for joining us. It seems like forever since we had the Sydney meetups.
I know. You know, it's definitely it's an unusual situation these days. You know, we all working from home at the moment as well. Yeah, we do come from time to time to the office after, you know, Australia actually did a really good job, you know. So now we start to go back to office probably 1 or 2 days per week. But by saying that, yeah, it's definitely a very precedent, you know, event. You know, we actually been working, can you believe, you know, we all working from home and it didn't really go out much for over a year now. It's just unbelievable.
Oh my gosh, I'm so jealous. Paul Clark, he says that we can still have in-person meetups here in New Zealand. I am so jealous.
Oh, yeah.
Ever since we had an in-person meetup, and I thought that we would be doing these online just for, you know, maybe a couple of weeks or a couple of months perhaps. But it's been forever. So it's really nice that we're able to hear from you, Ruby, because we have had guest presenters from all over the world, but it is Sydney is the meetup group that we used to have most frequently when we were doing it face to face. So you were quite a regular, weren't you?
Yeah, I used to join a fair bit, and it was actually quite good to see a lot of people, you know, who have passion about financial modeling, and they just come in, meet each other, and discuss, you know, various situations they face during the modeling, and also, you know, I actually found during the Sydney meetup in the past, we actually learn a lot from each other by just, you know, talking through certain things and the brainstorming, or, you know, and the share experience. So it's actually quite good. But yeah, but I have to say, you know, although New Zealand is also doing an amazing job about COVID, Australia probably also not too bad at as well. We actually should feel quite proud of ourselves, and, you know, feel like we are quite lucky compared to probably some of the people in other side of the world.
Oh, don't want to confuse anybody. She is not in San Francisco. You are here in Sydney, aren't you, Ruby?
I'm actually
not allowed to leave. That's
yes.
Right. Just drop a hi in the chat and let us know where you're coming from. We've got people from all over, I think, all over the world. So we've got somebody from cold London. So whilst you're doing that, I'll just introduce Ruby. Ruby Liu is KPMG's Valuation Associate Director. And I wanted to do a session on valuations because I thought that it would be quite interesting to really focus on what it's like to be a valuation practitioner and having to take apart other people's financial models to see, you know, when you set up the NPV and the IRR and figuring out, you know, is that sufficient to value an investment? So what exactly are you looking for when you use a financial model to assess the value of an asset, that sort of thing? And what I'm also hoping that Ruby will take us through is a little bit, just a bit of a peep under the hood at what it's like to be a valuation financial modeler. So Ruby's got more than 12 years of professional experience in corporate finance, valuation and financial modelling. She brings her unique modelling experience to advise KPMG's clients on business valuation and investment value enhancement. So, wow. I'm really excited to hear more about what you do, Ruby.
Yeah, it was my pleasure to join here and chat with everyone. As I mentioned with you earlier, Danielle, I think it will be I'm more than happy to share some of my experience, you know, and but I think it will be really beneficial and good to, you know, I know because it's not really face-to-face in person, but through the chat room to have more interaction with the larger group of the people. I can see it's literally, you're right, it's literally all over the world, you know, to hear, you know.
We've got London, Melbourne, France, Nigeria, Phoenix, Arizona, Warsaw, Poland, but she has temporarily moved to the Arctic. Wow. Florida, USA, Wales, Sydney, all over. Wow.
Okay. Yeah, it will be really interesting to, you know, hear other people from the other world, you know, about their opinion about the modeling, about the valuations, etc. And you know, hopefully, you know, during this session, it'll be relatively, I think I'm really keen to do this one as a relaxed session. So, you know, we can just more like we chat, it's a conversational chat and discuss different interesting topic about modeling and evaluation. And hopefully, everyone, including myself, will have something take away after this session today.
Great. So I'm just going to share. Is that correct, Ruby? So I'm going to share for you today.
Yes, that'll be great. And as I mentioned before, Danielle, I actually think it's quite interesting when how I feel about valuation when I was working at the modeling team, and now how I feel about the financial models, and the financial modeling when I'm sitting in the valuation team. So the idea and also the view actually changed a little bit. So that's why today, I think it will be good for us to discuss this topic. What is the best practice financial model from a valuation practitioner's perspective? I actually came out a couple of questions. Probably the first one will be what is a financial model? So when I was at KPMG modeling team, and also back in Quality, during the recruitment time, I used to ask the candidate, what is the financial model since you want to join the modeling team? And also, what is the difference between a financial model and a spreadsheet? And you know what? Surprisingly, more than half of them, they couldn't answer this question well. And I found it's very fascinating, people really passionate about financial models, but they couldn't really explain what is the difference between a Excel document and a financial model, which is it's very interesting. So that's where I think this should be our first question to discuss, and also will be good to hear from the chat room about about other people's view about what is a financial model. When I prepared this question, Danielle, I actually looked up from the internet about what is a financial model. And honestly, there are so many answers came out from the search engine. And if you can see, I actually copied two of the definitions from one is a Corporate Finance Institute, another one is Wikipedia, about the financial model definition. Do you think I may pause here, we both probably pause for 30 seconds or a minute, so people can do a quick read of the definition, and then we carry on our discussion. What do you think?
No, I think they probably had a chance to read that, I hope.
Oh, really? Okay, great. Okay.
We can multitask. We are fast readers.
Great.
And I will. I'm going to send this out after the session as well, so people will be able to read it.
Great. So as people can see, from CFI and also from Wikipedia, they all have slightly different definition of a financial model. They probably covered a different angle, but also they both make sense. So when I'm talking about what is a financial model and also what is the difference between a spreadsheet and a model, I tend to use an example or say story to explain. So I would say if I want to buy a house, which everyone probably know in Sydney is quite expensive, and I probably will open a spreadsheet and I will put my regular income and my regular expenses and other things probably over the next foreseeable future into a spreadsheet. I will, based on the market or the advice from my banker, to see, okay, what is the interest rate, and put into a spreadsheet to calculate, if I want to borrow X, what is my actually the monthly payout amount will be, etc., etc. So I will use this spreadsheet to do a lot of analysis and to assess, one, how much I can afford, and two, how much I basically need to pay at an ongoing basis. What does that mean to my, living styles, etc., etc. So that spreadsheet, I will not make it super pretty or user friendly. I may use some abbreviation, like say I will equal interest rate, probably the numbers all over the place, because I know what I'm trying to do, and I understand perfectly, for certain numbers, I look at it, I know that is my income, So like the salary is fixed every month for now at least, So those one I will call a spreadsheet. And then put it in this way, say if Danielle, then you noticed, Ruby is building a spreadsheet or say a tool to assess, her affordability and also whether she can buy a house at XY amount. And you come to talk with me, said, hey, Ruby, how about you make your spreadsheet a little bit, make some minor adjustment and send to me. I will use your spreadsheet or your tool to do some assessment of my affordability. And then later, a couple of other friends say, we just bring Lance in, for no reason. And the Lance also want to know, like, I actually also thinking about buying some property at Melbourne. Please, share the spreadsheet as well. So then when everyone started asking to share this tool, this become a need of a model or a tool. So I will not just like send my, back of envelope spreadsheet to you guys with all my informations. I probably will make sure the model has been separated into input, calculation, and output. And I will start considering it will have multiple input for different type of income, multiple input for different type of expenses, etc., etc. And I'll make sure, when you or other friends open the model, you actually can easily follow the model. I don't want every friend call me, say, hey, Ruby, I want to know how to, use this tool, etc. I want to make sure this tool can be user-friendly and also people can quite quickly understand the logical flow within the model. So that is probably, I would call the difference between a spreadsheet and a model. So after I share the model with you guys, with my friend, that one start to become a financial model instead of the initial spreadsheet I was built for myself. And I would say
that's a really interesting, that's a good definition. It's not how I would think of it, but you're absolutely right.
Yeah, that's where I used to talk with my team. And when we debate and discuss things, we're always thinking this probably will make more sense based on this comparison. And we found like, a model is normally will be used at least more than once. And one key thing we found is a financial model is normally built for repetitive usage and also built for not only used by the modeler, but by a lot of other people. So that's why it's a tool instead of just a calculation spreadsheet. So we found, that's probably a good illustration of a financial model when we used to discuss with the team a lot about this one as well. And I sometimes, will share this story with the candidate during interview as well. So that's probably, I would say, my understanding and my view about a financial model or a model, simulate about the future and the difference between a model and a spreadsheet. And when I chat with my team in valuation, and basically they just say, our financial model is a three-way, integrated model with balance sheet, cash flows, and income statement. And also, we will have a valuation sheet. Of course, they come from valuation, and have a valuation sheet. We can, do the DCF analysis. So that is actually their answer about what is a financial model to them. And if I ask, or I think back when I was at a modeling team before I joined Val, what I was thinking about valuation, it's definitely just like, about DCF, IRR, and also some EBITDA multiple analysis and to determine value of a business. So now then, to back to the second question, what is a business valuation? So what does business valuation mean? Is that only for DCF analysis with IRR calculation? So that's, again, I look at the internet and I found, interestingly, both Wikipedia and the Corporate Finance Institute, they also have definition about business valuation. So I also put it here so people can see, the same source about the two part of definition, financial model and a business valuation. And when I joined the Val, I realized business valuation, it's much larger than just DCF, EBITDA multiple, and also the IRR. Obviously, even for now, I think myself, I still keep learning about both financial modeling and also business valuation. But by saying that, based on my limited experience exposure, I can already see how large a business valuation is and how many elements and how many aspects business valuation has been covered. So I probably will say, and I'm pretty sure a lot of people understand this well, business valuation, it's not only a science, but also art. So it does involve a lot of like a quantitative analysis, involve about the mathematics analysis. But at the same time, I also found it involve a lot of judgment based on experience, based on your interpretation of the current macroeconomics, current market, and also investors' sentiment. So commonly, we will use the approach to do the business valuation is discounted cash flow, capitalize the earnings, which is another way people normally will talk about EBITDA multiple, EBIT multiple, etc. And another one, which is not that commonly used in transactions, it's the asset-based. So asset-based net asset approach, it's start from the book value on the balance sheet and then roll out based on some, and we'll identify the intangible assets, the market value of the liability and assets on the balance sheet. So basically based on individual asset class, net asset class, to determine the value. So these are probably the most commonly used approach when we're doing business valuation. And I actually can see, even from DCF perspective, most of people understand it has a lot of detail things we can dig in to find out this is not only that simple about, calculating to just like a calculate to discount all the forecast cash flow to get your NPV that simple, which we can always discuss later, when we start to talk with the larger group and share some of my view for reference. Yeah. And then next one I probably will see is how can a financial model help the business valuation? The reason I joined a valuation team, obviously, it's a slightly detoured from my career because, I always working in the analytics side, transaction and modeling. But recently, probably 2 years ago, I joined valuation. And I always found, yes, it's a little bit detoured, but I found financial model and valuation is really, really closely related. Because valuation, when we're doing business valuation, it's all about the future. I'm paying for asset for business, not because of how good it is doing in the past, because that is irrelevant to me. I will not get any money from an asset based on the past performance. I will more get the money from the future one. So that is why, I actually found the business valuation, it's always about future. And it involves a lot of like business forecasts and everything. So that's where all the forecasts is actually determined within a financial model. So we put all the assumptions, business drivers, etc., neatly in a spreadsheet and build it as a forecast model or financial performance forecast model. And that is actually a base for business valuations, quantitative analysis. So I may pause here, Danielle. Do you have any questions or you want to join in for some comment?
Yeah, there are a few questions that are coming up on the chat. And I just wanted to say for people who have got more sort of detailed questions, if you could put that on the Q&A at the bottom so that it doesn't get lost in the chat. And also if you are putting questions or comments in the chat, make sure that you address it to everyone rather than just panelists, because otherwise it'll only be me who sees it and Ruby is busy talking. So
yeah, and also I fully say I did see some pop up, but I really can't see. Can't see the questions, I have to say.
So we have a question from Henry just asking, how do non-financial factors contribute to the valuation? Do they come through financial lens or modeled directly as non-financial variables?
I would say first question will be, there are a lot of non-financial variables, depends on which one you are talking about. Say, for example, right now, the most hot topic about the ESG, the environment, social and governance, that is definitely non-financial factors. And how that one be, valued. It's literally, it's a big topic for the valuation industry itself. And I know the valuation institution, they currently are drafting a paper about that and get feedback from everyone around the world by saying that non-financial factors, obviously, most of them will not be directly reflected in a financial model. But that's where I was mentioned before. I think that's where the art part comes in. And in my personal opinion, I would say the non-financial factors, it's really, when we considering that in evaluation, I personally will definitely think that it's really based on the evaluator's experience and judgment to make a lot of the calls. So obviously we can still compare the non-financial factors with relevant companies, say comparable companies. But by saying that overall it is definitely, it's a qualitative part, and it definitely involves a lot of experience of the evaluator.
There is another question from Paul saying, can this be used effectively to determine asset stripping on companies with assets used being more than DCF? Are you able to see that? That's in the Q&A at the bottom. Are you able to see that question, Ruby?
I can't see that question properly. Let me have a look again.
Yeah.
I can see now.
Okay.
Can this be used effectively to determine asset stripping on companies with asset used being more than DCF? I'm actually not really following this question. I apologize, Paul. Yeah. Do you mind elaborate a little bit further? So when you say, can this be used effectively, what do you mean by this? You mean the non-financial factors?
Yeah, okay.
Or what does this represent? Yeah.
Yeah, I might just, we're probably going to get lots of questions here. In reality, are there multiple valuation techniques that are used to arrive at a realistic value? If not, are these techniques or methods more common across certain industries?
Multiple and DCF are probably the two most commonly viewed methods in the valuation industry. And you are correct, you will see some of the valuationer use multiple a lot, and some of them use DCF a lot. The multiple, it normally will be used, you can see almost every private equity firm, they will just directly go use multiple. None of them actually care about DCF. I have to say, well, that's not true. They do care about cash flow forecast, but when they make a transaction, they make a purchase, they're always based on the multiple. But by saying that, I would say, based on my personal experience, both approach has its pros and cons. For multiple, it's when we use a lot for a more mature company, because the company is more matured, the earnings are more stable compared to a startup. If a startup, the earning at the first year can be negative. And if you use the EBITDA multiple, you will get a negative price. Obviously people will more focus on its future profitability. But for the more mature company, their earning will be more stabilized, and also you will be more easier to find all the relevant comparable companies in the market, in the listed companies, they have a similar business models and business operations. So that's where, you will see people use multiple. And for DCF, it's really, you can really see the detail of the company or the asset's future cash flow forecasts. And you can actually tweak and push, about why certain forecasts will be in this way, etc. So the DCF one, especially for startup, if you don't have a long history or stable income, DCF, it's a very good method for people to do the valuation based on companies' future profitability and the future, potential to do the valuation.
And we'll just take one more question now. It's a good one because otherwise I can see we're going to run out of time.
Yeah,
there's a good one from Jack. He just says, "How do you think that the complexity of a model will affect the accuracy of the valuation?"
Oh, that is a really good question. So Jack answered this question, right? I have to say, I really love this question. It's basically, I would say, depends on the asset itself. And I will say a lot of times, I will say the model, it's overcomplicated for a valuation. That's probably the way I would say, because when we talk about it a bit later, as I mentioned before, valuation, we really look at it's the drivers of the value. So what's the company or what's the assets business or operational model, and what are the key drivers behind the business, behind the model. And then when we look at a financial model, or at least for myself, when I do a valuation and I look at a financial model, I will firstly try to look at the core value drivers, like the things, can really sweep the value a lot. So those are the things I will really look at, and I try to understand the logic behind that, and I will run the scenario and the sensitivity analysis, etc. So a lot of times, for the model when we get, that one actually have two elements. One, it's basically the modeler is not following the best practice of financial modeling. So the model gets really overly complicated and very hard to follow as a one. And the second part I would say is, if the model's purpose is purely for valuation, then a lot of things can potentially be simplified. But because the modeler sometimes they are not sitting there developed the model from a valuation perspective. So they actually build lots and lots of information into the model. And it'll be good sometimes, they are there, so we know if we want to look at it, want to stress test them, they are there. But a lot of times, we probably only use the core model part related to the valuation. Probably 1/5 of the model we are actually using for our valuation analysis.
Great.
But
I can see we've got lots more questions and comments in there, but do feel free to, we're not going to get to all of them. So for those of you who are at home, we've actually got a full session. So we have so many participants joining us today. So feel free to, answer each other's questions, because otherwise we will run out of time with, I know what Ruby has got prepared for us today. So we probably need to keep moving.
Okay, thank you, Danielle, and thanks very much for everyone asked the question. After this one, if Danielle, you don't mind, we can discuss and review the question to see how much, I can answer after the session and share with the group. And again, those some of the questions, I can only answer based on my own experience, and I will not guarantee, my answer will be the perfect one, but definitely based on my year's experience. So if anyone have a different view and a different answers, please feel free to type in and help each other. Yeah.
Mm-hmm. It's good when you get lots of different perspectives on this stuff.
Exactly. Yes. So now if we go back to the next slide, Danielle, please. I actually put down a few of the dot points about the good financial model from a valuation practitioner's perspective. This is not a complete list. It's definitely not exclusive. But by saying that, in addition to the common, best practice, because I always a big believer about if you can to achieve something, if you can make a thing simple, but not simpler, then go ahead, because you don't want to overcomplicate things. So like, even Danielle, when we talk about doing the meetup and with some other peoples, we always focus on, what is the best practice for financial model. And that one, you can see the fundamental answer. The fundamental answer is always like, try to make the formula simpler, try to make the model simpler, and the people can, follow in the model easily, and one model, one purpose, etc. So that is where, when I look at this one, so when I sit in the valuations lens, and I found, in addition to all this like common best practice, financial modeling best practice, I would say we always want to see a model have a clean valuation sheet. That is for sure. And we also will be good to have a three-way financial statement, because from the three-way financial statements, you can actually tell a lot about the company. And I have to mention one thing, since we talk about three-way, we need to make sure the three-way is actually interactive. So like, your balance sheet is actually balanced and linked with your cash flows, linked with your return earnings, etc. When I say three-way financial statements, I'm not talking about a P&L, balance sheet, and the cash flow. They just separately sit in the model, because that way I found, firstly, it actually has a lot of errors. Can be hidden, because your balance sheet will always balance if they don't talk to each other. And secondly, when for valuation, when we testing different things, if the three-way models are not working together, a lot of outcome won't be accurate as well. And then have a scenario manager. I have used a good scenario manager. I have used so many of the model scenario managers to do one scenario analysis. Another thing, it's about stress testing when I'm doing valuation, to try to understand, certain key value drivers from the common sense perspective, whether that one is the cost drivers, because, or value drivers, my bad. So for example, sometimes, everyone thinks CapEx, it's a big value driver. Everyone thinks, OPEX is a big value driver, but it's not really the case for some business. For example, for a business is more capital intensive, even you move their CapEx up and down a lot, the value will not change that much, because in the real world, it will never happen like that. So that's where I found, for valuation, when we use scenario manager, we always will do stress testing based on both mathematically and also the company's actual situation to do that. So a good and a robust scenario manager in a model is really, really helpful for us. And have a unit cross the model. That is actually a best practice in financial modeling. But I have to say, I really want to highlight this again and again. You guys probably have the same situation. Then now we'll definitely for sure, how many times, I was sitting there and wondering, is this dollar in thousand, or is just dollar, or is dollars in million? It can't be in million, but it also doesn't feel like in just dollars, because during the whole model, I just can't find a unit. I don't know whether it's in US dollar, especially for some international companies, their model, they are really, really large company. They have all business all over the world. And based on the model, I can't tell whether it's in US dollar, Australian dollar, or pound or euro, or whether it's in thousands or millions. So that one, I found it's extremely important for valuation perspective as well. And also, it will be good to have some actual data in the model from valuation perspective. When I personally doing valuation, I found it will be good to, if the modeler already populated the actuals, because actual is always the good reference for us to have a look and have a test. And I actually found, once we have the actual, especially from equity injection and distribution, it's really helpful as well. So that's probably something, I really found useful when I see a financial model have those functionalities or those sections when I do business valuation. So that's probably one key part I want to highlight. And also that is a key question. I also really keen to hear, if the large group have any other comments or any other suggestions from valuation perspective. When you're doing valuation, it will be really, really good to see this or that in the model. So now I will share a couple of examples. Obviously, those of them are very simple and just for demonstration perspective. And Danielle, I think we can share this with the larger group after the session. Is that right?
Yeah. Can you see the Excel model now?
I can, but if you don't mind, maybe need to be zoom a little bit because I can't. It's quite small. Yeah.
Sure. How's that? Yeah, I'll send this out afterwards to everybody who has registered.
Yeah, great. And so this one, it's a very, very quick snapshot about the valuation section in a financial model. So this one, you can see it's have the free cash flow to the firm or to the project if we are valuing a particular project or doing for project finance. And we have the free cash flow to the equity. And we also have the valuation section, which in this case, we have the NPV, we have the IRR as well. So first thing I would want to highlight here is we want to make sure the valuation sheet is quite clean and very easy to follow from top down. So I can clearly see, what are the sections mean and what's the relationship for each other. And another thing I want to really highlight is consistent. So I have done a lot of model review, also a model audit as well. It's surprisingly, how many times the valuation sheet, the discount rate, it's not consistent with the cash flow. So that's where something I really want to use this forum as an opportunity to highlight as well. So when I say discount rate, it's not consistent with cash flows. So if someone used the first principle to build a model, to build the NPV, then you need to make sure your rate has been properly calculated to align with your period. For example, if for this case, you can see it's a quarterly model, then if I'm doing the first principle, then I need to make sure my rate has been transferred into a quarterly rate before I discount the cash flows. And another thing is if my discount rate is a nominal post-tax discount rate, then I need to make sure my cash flow, which will be discounted to calculate my NPV, it's also a nominal post-tax cash flow. So those type of consistency is probably one of the number one principle in valuation. And during the model audit, I have seen so many times, the discount rate is not aligned with it's just not aligned with the cash flows, simple like that. So that's something I want to highlight. And also I want to talk about it's the formula. So Danielle, if you don't mind, put cell into the cell F30, I think. My bad, it's no F30. It's actually the rolling NPV into the probably the L31, please.
That one?
Yeah, so yes, thank you. So you can see I'm actually use the X NPV here. So obviously, we can definitely use the discount factor, which is from the first principle. We basically calculate our discount factor, 1 divided by the 1 plus the discount rate times of the timing. But in here, I basically use the X NPV. So these days, I see a lot of modelers are using the X NPV now, which is good. And occasionally, I will still see people use NPV. And when you use NPV, there are some of the flaw for those formula when Microsoft built the formula. So firstly, NPV will only capture it's basically assuming every cash flow will occur at the identical time slot So they either assume the cash flow will occur every 30 days, every year, or every month. But when we're doing our valuation, you will see if we actually calculating the number of days in each period, the number of days will be slightly different in each period. So XMPV is really, really good for automatically adjust this issue. That's one thing. And also for MPV, we have to make sure the rate is consistent with our cash flow. So for example, this one, we have quarterly cash flow. If you use MPV formula, you actually need to basically, change your discount rate into a quarterly rate before you use the MPV formula. But because now, we use XMPV, so Excel already automatically updated this calculation on our behalf. So that's why I don't need to worry about clearly right now the WACC here. It's an annual rate, but I don't need to do any manual adjustment. The XMPV formula will do that for me. So that's something just keep in mind. And another thing I want to highlight is XMPV. You can see on the top, the syntax of this formula is the rate and the cash flow and then the date. So in this example, the first date XMPV selected here is the 31st December 2021. So basically that is your valuation date. And that's where, the XMPV formula assumes your cash flow occurred at the end of each period in here. That's just basically the assumption. And your valuation date will be at the 31st December 2021. And the cash flow was, in this case, either the FCFF or FCFE will be included in this period as at 31st December 2021 will be included to calculate the MPV. So that's something, you need to keep in mind about the date, because if we choose the date in the syntax instead of row 7, we choose row 6, then basically the XMPV will assume every cash flow occurred at the beginning of each period, and your valuation date now changed to the 1st January 2021 instead of the 31st December 2021. So that's something I also noticed in practical, in practice, a lot of modelers, when they're calculating the MPV, they are not really pay attention about the date when they choose. Because for this case, you need to understand, firstly, the formula assumes everything happened at the end of the period. And also the valuation day will be the 31st December 2021 in this particular formula. And also the distribution, or say the cash flows as at the valuation date, will be included into this calculation, into the MPV. So sometimes, you will hear people talking about X dividend and a COM dividend. COM dividend is basically this example here. It's the dividend occurred as at the valuation date have also been included into your MPV calculation. X dividend is because the dividend is paid as at the valuation date, we actually exclude this dividend for our valuation. So that's where, when we doing the valuation sheet in a model, those key valuation principles or considerations are definitely worth to consider, and to make sure the value we eventually presented in our model is actually correct. And also, Danielle, if you can please, move to the next sheet. So the next one is something, I just want to show you guys. So this is a couple of presentations or the charts. You will see a lot from valuation report or valuation analysis. So this one, currently Danielle is showing, it's a sensitivity analysis. So basically, we trying to identify a handful of the key business drivers, and then we do a sensitivity analysis to say, if I use a good example. Everyone probably know discount rate is a big driver to the value. So for this one, the first one you can see, it's if I increase or decrease 50 bips in my discount rate, the cost of equity in this case, what does that mean to my equity value? So this is a very common presentation you will see in valuation report, or I found it's very handy in the valuation model. So people can clearly see, okay, those are the key drivers. And once we do different sensitivity analysis, I can understand all those key drivers, what are the impact on them? Sorry, what are the impact on the value from those key drivers here? So that's one example. Another example, I think a lot of people probably already seen that. So Danielle, if you can please move to the next sheet. Yeah, so this one is the value bridge. I think a lot of people have seen this one before. So basically, you know, especially when we are valuing some business or assets for fund managers, and they would like to understand their assets value trend and what are the underlying drivers of this value trend. So we'll have the value number at the last valuation date, and we'll have our valuation number at the current valuation date. And in the between are the drivers, like basically it's like how the value from the previous valuation date to now, and what are the drivers behind, and how this value can be bridged step by step until today's value. So this one is also very common presentation or say output you will see in either valuation report or valuation model. And I have seen people done this in multiple ways. Sometimes people will basically build those things into a scenario, and then they use relatively complex macro to automate this process. And sometimes people will just build this bridge, you know, into the normal scenario manager. And then they will have the table just like this one. Currently, Danielle is showing here. And basically, you know, just manually like run different scenarios and then manually typed in, you know, after I run first scenario, what's the answer? After I run second scenario, what's the answer, etc. And so those scenarios are basically the changes between the previous model and the current model. And then they just record all these value changes as a manual input with some comments here. And the benefit of this method is you don't need to carry a really complex macro. And even with macro, sometimes you may have some human errors, you know, if the people don't really follow in the instruction, or if people put the numbers into a different cell or into the incorrect rows, etc. So this will be more straightforward for the model, for the modeler, but for the reviewer, basically it's like for valuation practitioner, when I look at this one, if these are all hard-coded and I can't really trace back, then I would say, you know, it's pretty, I would prefer I can actually see the macro and understand, okay, what are the drivers behind, what's the changes, and what kind of steps the model has done to give us this valuation bridge. So I actually saw both, and I can understand the pros and the cons for both approach. And it would be good to know if there are any other approaches people see in the practice, you know, like whether they have some formula to solve the algebra directly without using macro or without, you know, manual input, and still have clear the calculation trails, etc. But that's another good example, you know, we see a lot in valuation when we conduct a valuation. And the last one for tonight, obviously tonight I just want to show some of the examples I saw a lot, you know, when I'm doing valuation. And I'm sure there are a lot of, like, for example, valuation football, you know, football field, and there's a lot of other valuation presentations, you know, charts or approach to understand the different drivers to the business valuation out there as well. So we just touch for the timing reason. Just touch few of them. I see a lot in my work. And Danielle, if you don't mind the last one. Yes, thank you. So this one, it's I would like to call it, it's not really for valuation report, but for some analysis we actually doing. So as a valuator, as mentioned before, you know, sometimes it's not only about the numbers in front of you, you know, like, yes, the company will have their forecast, you know, they will have their forecast, and they will have their board papers. They will tell you what's the management's view of the company. But there's something called, like, you know, larger macroeconomics, you know. So what's the current interest rate, you know, all the central banks, you know, the QE measures, and all the market, you know, all of this are extremely important to valuation when we value a company, because the company is not like independently sit in a bubble. It has to interact with other companies and interact with the market, and also investor sentiment is a very important one. So from time to time, we'll do some statistics analysis to understand the share market. So if there is a correlation between the share market with timing, if there's any other correlations, you know, between the share market and the bond yield, etc. So we'll do a lot of like analysis. And because we are in 21st century, and Danielle also mentioned, you know, we have few sessions, like I think I saw a few sessions Danielle actually did before. It's about Power BI. So we also use Power BI a lot to conduct some dashboard presentation and doing some analysis by using DAX language. But what I want to show here is, unless your data is massive, Excel is still a very good tool to do some statistics analysis. You know, if you have a massive data set, then I probably will suggest Python, which is a really good language to do the analysis. But if like for us, you know, honestly, for stock market, I would always find, you know, Excel can do those type of analysis as well, just by, you know, enable the data analysis. So this is something, you know, we also have done before, to just trying to understand the correlation between two factors in the market or in some of our comparable companies, etc. That's another probably a demo example, just to give you some flavor what kind of things we are looking at on a daily basis. And that probably will be the key part and the key things I want to share with everyone. And I just realized, Danielle, we have 7 minutes left. So I probably would say this today, as I mentioned before, it's based on my personal experience and my own view. And I just want to, you know, share some of the opinion and some of the examples as a start point to simulate a discussion. And I really found, you know, it is really important for people to understand, you know, when we look at, even for modeler, you know, to understand that when we look at modeling, when we're standing from different angles, the requirement for the model is quite different. Like I joined Val, sometimes I look at a model, will be in a very specific angle to look at it. But I still remember when I was at Coority doing a lot of like a project finance model, all we care about is debt sizing. You know, it's really about debt market. It's really about how the bankers are focused on, etc. So that's where I was thinking, for modeling, there are a lot of like a common best practice. But at the same time, you know, I'm a big fan of one model, one purpose. I feel like if you want to build a model to meet multiple purpose and to make everyone happy, that model will become extremely clunky and complicated, and eventually likely will become a monster, and then end up, you know, not many people will use the model. Like at least when I open a model, if the model runs extremely slow, I will just like, let's copy some key numbers out to our model and then just run our model to do the valuation. So
just asking trouble, isn't it, when you try and use it for something that it wasn't intended.
Exactly. Yeah. So that's where I just thinking, you know, those are some things I just like to share. But by saying that, I'm pretty sure, you know, there are a lot of good approach and angle about what is a good model from valuations perspective, what's a good model from bankers perspective, what's a good model from project finance, you know, perspective. So I will leave that problem with Danielle. I think Danielle knows a lot of like good people in the industry. Like some of them are my friends. So I'm pretty sure Danielle will keep, you know, bring this type of interesting discussion.
Speaking of which, we have Ian Bennett next week.
Oh, yeah.
So I'm really looking forward to that one as well. So
yes.
Scoring model risk. So that's going to be a pretty cool session. So we're pretty much to time, and I know that you are so busy at the moment, Ruby.
That's okay.
I don't want to keep you any longer. I would love to keep you longer and answer. I know we've got lots of really, really good questions, but I'll send them to you and see if you get a chance to have a look at them. And what's the best way for people to contact you if they want to ask you anything? Can they, or is that probably a bit busy, aren't you?
I would really encourage people to, you know, like first, definitely, Danielle, please send me all the questions in the Q&A, and I will make sure I answer all of them. And then you can share with the people who registered tonight so they can see the answer. And if people really want to ask any following questions, I would say through your meetup channel probably is the best one. I don't know what's the if there's any like a forum after the session, people can keep asking some questions, but I would definitely suggest, you know, through your meetup channel will be a good channel to
maybe
answer
on the
questions.
YouTube video you can you know, post some more.
You didn't tell me we're gonna put it into the YouTube, otherwise, you know.
Did I mention that? I thought I told you that.
That is all good. If that's the case, I will not put San Francisco. I should put Sydney as the background, you know. We feel like we are in Australia.
Exactly. Yeah. You've got a bit of a fan club going on in the chat. I think we're going to have to get you back again because people are saying that they want to see more of these type of sessions. So
thank you.
Everybody really loves this technical stuff of seeing particularly that blend of how you actually bring that technical expertise to your career as a financial modeler, and it's really interesting to see how you actually apply that in real practice. So thank you so much for sharing your world with us.
No, it's definitely my pleasure, and I always find, you know, I have gathered a lot of like really good people to share their knowledge and help my career to grow and progress. So obviously, you know, there's still a long way for me to go in modeling and in valuation as well. But I really have a big passion about, you know, work, especially with all the technologies, you know, work with the global, like with people all over the world. We can share things and we can, you know, learn from each other. And I know the valuation in US, they will have some slightly different, you know, focus on value. They use if you look at the McKinsey's valuation, they all about, you know, cost of capital and the return of the invested capital and the economics profit. So they all different around the world, although the fundamental principles the same, and the same as financial modeling as well. So it's literally my pleasure. And send me the questions. I'll make sure I answer all of them, and you can share with the larger group.
Thanks so much, Ruby. And I hope to see you next week. We've got another session for the women in financial.
Yes.
Well, so I'd love to see you there also. So thanks, Ruby.